Deep in the underworld of modern finance, money is being conjured. Not by printing presses, but by keystrokes and ledgers. Imagine walking into a bank on a quiet afternoon. You hand the teller $1,000 in cash, your hard-earned savings. The bills vanish into the vault, and your account balance blinks $1,000. But here's the uncanny truth. That simple transaction just set off a secret process, an ancient alchemy banks use to multiply money. In the span of seconds, your $1,000 can become $2,000, $5,000, even $10,000 in the financial system. Money from nowhere, created with a few clicks. Sounds like a magic trick, or perhaps a scam, yet it's the foundation of our economy. And as long as we believe in it, the system hums along. But if trust falters, the illusion could shatter in an instant. Are you ready to discover how banks pull off this money miracle, and what dangers lurk in its shadows? Let's break down, step by step, how a single deposit can multiply into many times its value under a system called fractional reserve banking. It all begins with a typical deposit. You deposit $1,000 in Bank A. In your online account, you still see $1,000. It feels like that money is just sitting there safe. Behind the scenes, Bank A is required to keep only a fraction of that deposit as cash reserve, say 10% or $100 in this example. This is, just in case, money for daily withdrawals. The other 90%, $900, is now excess reserve that can be loaned out to someone else. Bank A finds a borrower and loans out the $900. Here's the crucial part. The bank doesn't hand out grandma's $900 cash from the vault. It typically creates a new deposit of $900 in the borrower's account. In that moment, new money is born as a digital entry. Your original $1,000 is still in your account, and now an extra $900 is in the borrower's account. The borrower uses that $900 to pay a vendor. The vendor then deposits $900 into Bank B. Now Bank B has a fresh $900 deposit on its books. Bank B also keeps only 10% and $90 in reserve and lends out the remaining $810 to another customer. Just like that, Bank B created another $810 deposit for a new borrower. Now there's $1,000 in your account, $900 in the vendor's account, and $810 in yet another person's account, money multiplying as it moves. Repeat the cycle. The $810 loan might be spent and deposited in Bank C, which keeps $81 at 10% and lends $729 to someone else. Then $729 goes to Bank D, and so on. Each time, a new loan deposit is created, though each is smaller than the last. This chain continues until there's no excess reserve left to lend from the original deposit. In our 10% reserve example, that initial $1,000 can ultimately support up to $10,000 in bank deposits across the system. Your $1,000 is still yours on Bank A's screen, but roughly $9,000 extra has been created in many others' accounts via loans. Money has been multiplied tenfold. This fractional reserve process is how commercial banks create money. They don't literally print cash, they expand the money supply by issuing credit. In fact, the majority of money in modern economies is not physical cash at all, it's bank credit. Every time a bank grants a loan, new money springs into existence. Every time a loan is repaid, money vanishes from the system. It's a delicate balancing act of creation and destruction happening in the shadows of everyday banking. This is fractional reserve banking, a fancy term for the bank keeps a fraction and lends the rest. It's a centuries-old practice, born when medieval goldsmiths realized not everyone would claim their gold at once. They began issuing more paper receipts than gold they held, effectively creating money and charging interest on it. Today's banks operate on the same principle. Only a fraction of deposits are held in reserve for withdrawals, and the rest is used to fund new loans. This fuels economic growth by putting otherwise idle money to work as credit. But it also means that banks have an extraordinary power. The power to create money out of nothing within certain limits set by law and economics. Implications and hidden risks. The money magic of fractional banking comes with side effects and dangers lurking beneath its shiny surface. Here are some of the hidden risks and implications of banks' ability to multiply money. Bank run fragility. Because banks lend out most of your deposit, they don't have all your money on hand. If too many people ask for their money at once, the bank could run dry. This is a bank run a panic when everyone rushes to withdraw and the bank's vaults can't cover it. Today, measures like FDIC insurance and central bank backup exist to bolster confidence, but the fragility remains. If trust in a bank or the system evaporates, the illusion breaks and banks can collapse overnight. Debt, bubbles, and crashes. When banks can create money easily, there's a temptation to lend aggressively. This can inflate bubbles, for example, an overheated housing market fueled by easy mortgages. But if those loans go bad, the created money vanishes and the bubble bursts, causing a crisis. Money created out of nothing can disappear into nothing, leaving economic wreckage behind. Power and control. This system raises a profound question: who really controls the money supply? It's not just governments or central banks. Commercial banks hold immense power in determining how much money circulates, by their collective decisions to lend or not lend. Yet, surprisingly, even many policymakers and the public don't fully grasp this. This hidden reality means that much of the economic fate of nations lies in the hands of bank lending officers and credit committees. It's a power so large that it warrants the dramatic description: modern banks are the gatekeepers of the money universe. The illusion of ownership. When you deposit money, you might think it's your money in the bank. Legally and practically, it becomes the bank's money, and they are using it to make more money. Banks earn interest on loans made with your deposit, giving you a tiny cut as interest, if anything. It's a provocative analogy. After all, if you printed money in your basement, you'd go to jail. But banks do it within the law, as an integral part of the system. So, whose money is it really when it's created this way? We started with a mystery. How do banks create money out of nothing? Now we've seen the trick revealed: fractional reserve banking, a system of confidence and leverage where bank balances are mere promises layered upon promises. It's a story of invisible money multiplication that fuels our economy's growth, yet courts the risk of sudden collapse if the spell ever breaks. This blend of alchemy and fragility defines the financial underworld we all live in. Every dollar in your account was born from this system, a system built on trust, debt, and the delicate dance between banks, borrowers, and regulators. It leaves us with a question echoing in the vault: if banks can create money, who really owns it? And if money can be conjured from nothing, what is it truly worth?